joining us today. My name is Samantha and I'm in client services here at the Retirement Group. I moderate these weekly webinars. Thank you so much for joining us for one of our weekly AT&T webinars. We know that as you approach your retirement, you should have a solid plan for your future. In a moment, we're going to be joined by Patrick Ray, who's an advisor here at the Retirement Group, and he's going to be covering some crucial points for you to keep in mind, such as how elevated interest rates could potentially affect your lump sum. Before I bring Patrick on, however, I'd just like to remind you, although we work very closely with both active and retired members of AT&T, we are not affiliated nor endorsed whatsoever by AT&T. The Retirement Group is a completely separate entity. I'd also like to let you know, throughout Patrick's presentation, I will be entering some very useful links into the chat. They will guide you to our online education center where you can view a full library of all of our past AT&T recordings on topics you may find of interest or concern. I will also be entering a link to LinkedIn where you can follow us for upcoming webinar updates, and a link to book an appointment with an advisor after this presentation. So I hope that you'll take advantage of those very valuable resources. And with all of that boring stuff out of the way, I'd like to just now introduce you to our speaker today, Patrick Ray. Hi, Patrick.
Good afternoon, everyone. Thank you, Sam. I appreciate that. And welcome to today's presentation. We appreciate you spending some time with us today. And my objective is one of many, but mostly to give you some value in what it is that we have to chat about today. So today we're going to talk about the retirement plan at AT&T, and specifically how within the framework of your options of what you choose as a payout system is if you choose the lump sum option, how that affects you, and why you may want to be concerned about the changing interest rate environment. So we're going to get into that in just a moment. And as Sam had mentioned throughout the presentation, there's going to be links into the chat to give you access to some of the things we've recorded in the past in case you'd like to join us for other topics that we talk about for your healthcare or your 401ks or some specific tax type things that we encourage people to think through when they're preparing for one of the most important financial decisions that they ever had to make. And so for those of you who are not familiar with the Retirement Group, we have been around for over 30 years, and we have a team of a ton of experience in helping folks transition into a successful retirement. And as it turns out, one of the things that we do in an effort to help people with that process is bring to you these educational formats so that you can do your best to understand to the greatest degree you can what we get as a very common attribute of conversations and, more importantly, questions from people who are in your shoes on what to do when they're leading into a decision as important as retirement. And so we have offices across the country, and we have an intimate knowledge of your 401k and your pension plan and your savings plans and your healthcare benefits and all of these things that would help encourage you to understand what it is that and what it takes and what's best for you and your family when you're leading into retirement. And one of the things that you might find the most value of actually is the cash flow analysis that we have, which is a complimentary service in an effort to gain some data with you. So if you're interested in spending a few minutes with us, we're happy to put one of these plans together, which kind of outlines the scenario of what your cash flow and your income looks like, and then what it means to your net worth over the life expectancy between you and or your spouse in the event that you're married. So you may want to take us up on that, and I'll give you a way to get access to us at the end of the presentation if you're encouraged or interested in doing so. For those of you who are not following on us on our LinkedIn page, I encourage you absolutely to do that. We have a ton of great information. It's really short pressed in some cases where it's just kind of good guidance, or sometimes it's answers to very simple questions or very common questions, or it gives you access to these webinars and things that we do for educational purposes. So we encourage everyone, if they're not already doing so, to follow us on our LinkedIn page. So let's talk about the annuity first. And so, as you know, from a payout perspective, you have an option to take an annuity as a payout, which means that there's a formed check to be payable to you for the balance of your life, regardless of how long you live. And then there's some caveats to what happens if you die, or if you are married and you are electing a joint survivor option, what happens to those payouts. And we'll talk about those in a minute. But what you need to know in the core context of the annuity is that it's generated on a single life based on age 65. And so the key is to determine if you were eligible or if you were non-eligible based on your legacy plan's merger date. And so that formula depends as to what applies, or which formula applies to you, on the timing of your ability to be service pension eligible as of that date. And so For those of you who do not know that, this is probably a relevant time to spend a few minutes with one of us or one of my team members in an effort to help you gauge the understanding and the specific date for that, because it's unbelievably crucial to understand this, regardless of what plan option that you plan on taking when you ultimately retire. And so if you're an eligible employee after your legacy plan's merger date, then basically these context of the single life annuity payments are core related to your age 65. And so that's what you need to know for that. And so from a distribution option perspective, you've got a single life option. If you're married, you have an option to take a joint and survivor option, which allows you to take a little lesser monies, but to be able to extend that payment to your spouse if you suffer an untimely death. We're going to talk a little bit about what the look-back period is, in case you've heard of this term or people are referencing this term, or in fact you've seen an email that came out, which have been pretty standard over the last 4 or 5 years or so, which in AT&T's case is letting you know that there's a difference in the interest rate environment and kind of how that applies to you and what historically it means. So we'll talk a little bit about that. And that ties to the interest rate environment, which obviously we will spend a few minutes on as well. And then we'll talk about your lump sum options. And so from a single life annuity perspective, okay, this is the monthly payment that all forms of payment are derived effectively. And so what the company allows everyone to do in this case is, because there's a lump sum option, and just so you know, not all plans are similar, and not all plans work like this, but it allows you to convert this single life annuity payment into a lump sum format. And we'll talk about how that works in just a second. But basically, this single life format gives you a fixed payment every month for your retirement lifetime. And so whether you live for 6 months or whether you live to be 104 years old, they're going to pay you a monthly payment for your lifetime if you elect the single life annuity payment. Now, if you're married, you might consider taking the joint and survivor option, which is a payment option that elects you to get lesser monies while you're alive. And then when you suffer an untimely death, those payments are carried on to your spouse. And so upon your death, a percentage of what is paid to you is basically paid to your spouse. And so you might see the difference in between 50 and 75 and 100% options. And effectively, what you need to know is the more you ask the company to pay your spouse when you die, the less they will pay you while you are alive. So let me repeat that. So the more you ask the company to pay your spouse when you die, the less they will pay you while you are alive, right? And it kind of makes sense, obviously, because what they're doing is they're incorporating not just your life expectancy into these lifetime payments, but the combination of you and your spouse. And so, of course, as I mentioned, the reduction factors are relevant to not just the payment of your spouse or if your spouse is involved, but we could go further, and you may want to watch the pension presentation that we've done on the specific penalties, on how the penalties work in the event that you're not service pension eligible. And we won't get into too depth of that today, but those are a factor. But one of the most unique things about the AT&T pension plan that many plans do not have, and so this is kind of a neat benefit, if you will, if there's such a thing to this, if this actually happens to you. But there's a pop-up provision. So if you look at the Fidelity printouts, when you run a calculation of what your pension is worth on a specific date in the future when you actually retire, you're going to see that the annuities have this word pop up in the term as to the payments that you can ultimately elect if you choose to take that payment election. And what that basically means to you is that if you sign up for the joint and survivor option to some level, 50% or 75% or 100%. The real question is to you, well, what happens if your spouse suffers an untimely death before you do? And so the reality is, of course, there's nothing that you can do to control that, but there's a protection built into the plan, which is kind of great for you as a single life payment, which means that if your spouse that you've elected while you're retired a lesser payment so that they can get paid when you die, except they die before you do, you will be allowed to get reverted back to what they referred to as the single life payment, or what that payment would have been if you would have otherwise selected that at your retirement date. And the only thing you have to do is fill out a form at Fidelity and provide them with a death certificate of your spouse. And this would allow you to get bumped up to the single life format. And of course, albeit not the ideal scenario, clearly because you've lost your spouse, at least you would have not given up those payments for the remaining balance of your lifetime to protect someone who won't be able to receive those payments. And so that's what that pop-up provision is in the event that you've ever had to concern yourself with that or think about it. That's what it actually means to you. Now, something we've been talking about at nauseum, unfortunately, when the interest rates have changed. And you may also know that AT&T has gone out of their way in the most recent 4 or 5 years to let everyone know that the interest rates are actually changing and that you might want to be cognizant of what we refer to as a look back period, which is a period that obviously we are past that has relationship to the historical interest rates and what it means to the pension plan itself. And so companies use a look back period to give employees some necessary understanding, if they hadn't already done so or understood, uh, what it means to them if they elect a lump sum option to their pension plan for their future retirement. And so, because the interest rate has a correlation to your pension plan, and when the interest rates go up, your lump sum goes down. And when the interest rates go down, your lump sum goes up. So they actually have an inverse relationship, as it turns out. But you need to be cognizant of that because it may affect the timing of when you elect the technical payment. So just because you retire in a given year doesn't mean you automatically have to or that you're required to take your payment. In fact, you're welcome to defer if you wish. You just need to understand that there are some caveats to that, and we'll talk a little bit about that here in just a moment. But as I mentioned, higher historical interest rates might lead to a smaller lump sum and vice versa. So historical interest rate trends tend to have look back periods that can affect the present value of your distributions, which in turn means that it brings some stability and some predictability to your pension calculation. And one of the things that we don't talk much about, but I'll bring up to you is that if you, in the most recent past, and it hasn't been that long since they changed this, but AT&T changed for the managers the calculation window of when the interest rates apply. And so they used to affect the rates on a quarterly basis, which in turn affects the managers and their decision of the timing of when they left the payroll. So as frequently as 4 times per year back in the day, they had to make, and managers I'm speaking of, had to make a decision on what it was best for them from a financial perspective on when to put in for their retirement. And so that mattered to a great degree, and the frequency of that was almost too much. But a lot of plans still use the quarterly update. But in this case, AT&T has changed to the annual update. So this look back period at least gives you some timing as to the length of window that you're dealing with before you can actually commence your pension benefit. And so it's kind of a nice feature to have, or at least you've got a longer window in the calendar year to make your decision if you choose to actually commence your pension benefit. So as I mentioned to you, the interest rates have an inverse relationship, and the best way to look at that is to look at this teeter-totter thing. So when the interest rates go up, the lump sum goes down. And most people are pretty cognizant of that at this point because of all the discussion that's going on in the most recent few years, and all the people who have either lost their jobs or retired would know that that makes sense, and they've heard of this before. But let's talk a little bit about the historical past so that you kind of have a vision for what this look back window kind of feels like, or what it would have been otherwise if you decided to postpone your payments, for example, if you retire. So there's 3 different segments to the rates. Okay. So you have segment 1, segment 2, and segment 3. And by the way, when you go log into Fidelity, if you're always, or if you ever wondered why there's 3 different segments, because the interest rates have broken out in the corporate world to apply to 3 different timetables of your retirement. And so segment 1 deals with the first 5 years of your retirement. Segment 2 deals with years 6 through 20. And then segment 3 deals with years 21 plus. So for most of you, the most important segment of these 3 numbers are the second segment. Okay. But as a combination, they all have an impact because it's a combined effective rate. And what we have here is this grid of the most recent few years of what the interest rates look like. And so if we go all the way back to November of 2017, as I mentioned, it's been a few years since they changed this, but as of 2017, they allowed you to convert this interest rate change to once a year. So in November, they calculate the rate, and that rate that's established in November of 2017 was good for all of 2018 retirees. And so those rates were as follows: 2.20 for the first segment, 3.57 for the second segment, and 4.24 for the third segment. And what you've seen in this transition from 2017 to 2018, and then 2018 to 2019, 19 to 20, 20 to 21, and 20 to 22, where we're at currently, is that this trend has been all over the map, right? From 2017 to 2018, they significantly increased. So if you were considering retiring in 2017, or excuse me, and or 2018, and you knew that the rates were going to be different by almost 1.5 percentage points, that would have affected your lump sum by about 15 to 20%, just so you know. So for every 1% of interest rate change, it changes your lump sum by roughly 10 to 12 percentage points. So because of this 2018 number, you might have otherwise postponed your payment, hoping that the interest rates go down the following year. But remember, that calculation in 2018 meant that the rates were applicable for 2020. So this might have encouraged that person who was on the fence of retiring in 2017 or 2018 to go ahead and commence their benefit in 2018 to get the 2018 rates, which were significantly lower. Now, as it turns out, you go from 2018 to 2019, and then when they calculated the rates in 2019, there was a significant drop, even less than what they were back in 2017. So this would have meant your lump sum would have went up. And so if you were patient enough and you didn't need the money, for example, to wait another year and you wanted to risk what the interest rates were going to do the following year, it would have been even more beneficial because the rates went down again in November of 2020 for the applicable rate of 2021. Now, the significance of that is that meant that if someone was retiring in 2019 or 2020 and they were playing the interest rate roulette wheel, for example, trying to figure out when the best timing of when to commence their benefit is, they would have had to go on a full 2 years without being able to access those funds. Because this discussion is only relevant if someone were to technically leave the payroll and not commence their benefit, right? So in this case, where we see a significant jump is from the rates of 2021 on to 2022. And then for 2022 going into 2023, we have yet to find the rates because it's obviously not November of 2023 yet. You can see what the transition rate has been from this because we calculate this or we track this rate on a monthly basis because even though the rates don't impact your pension except for once a year in November for the following year, that rate actually changes once a month. And so because of that, we know that as of the most recent rate, which is in August, the first segment has went up a little bit. The second segment is about even, and the third segment has went up a little bit. So this may mean that for that person who's considering retiring in 2023, that they may want to leave the payroll and actually commence their benefit because it appears that the rates might actually be just a small amount higher in 2024, meaning that it would be less money that you would otherwise get in your pension lump sum if you chose to wait for a calendar year and chose to commence your benefit in 2024 instead of 2023. So on the lump sum side, it's good to know that the lump sum is an actuarial calculation. And I've got a slide to kind of share with you the difference in rates and what it means to a payment. So you kind of have a better visual because I'm a visual person. So I like to learn like that. And so I'm going to show that to you in just a moment. But as a discussion, the lump sum payment is an actuarial equivalent to the amount of money that the company would need to give you in today's number to turn around and regurgitate those payments as a single life payment for the rest of your life. And so they use a combination of actuarial figures and they base that also on your age and interest rates. And it could be deflated by not just interest rates, but also penalties, given that you're not service eligible or that you're not over the age of 55, as an example. So these things have a combination of what they mean to your overall benefit. But assuming that you take the lump sum and once those payments are paid out to you, understand that there's no death benefit available in that particular pool of money. And that's because, of course, you chose to take the money out. And we assume that, whomever it is that you want to have the money is labeled as the primary beneficiary of the IRA that you have as a landing spot for those lump sum funds. But as a kind of a visual, I wanted to share with you this difference between viewing your annuity payment like a mortgage payment. And so if we were to assume that you had a $1,950 mortgage payment, as you would a $1,950 annuity payment. So you're either going to get a check for $1,950 from the company, and we want to kind of see what the interest rates do. If we relay that to how your mortgage is paid, and you have a $1,950 mortgage payment, if your mortgage was fixed on a 4% number, which is good in today's terms, by the way, congratulations if you have a 4% mortgage right now, but your annuity payment was correlated to 3% because the actuarial calculations and the interest rate environment in November that's calculated would give you a 3% number. If you had the same 30-year window of time, you can see that you would have gotten more money in the lump sum by over $50,000. So if the rates are 4%, you owe $408,500, or you would have gotten $408,500 as a lump sum. But if the rates were 1 percentage point lower, you would get $462,500, which is over $50,000 difference. So this matters. This discussion of when to commence your benefit and what the interest rates are doing, it absolutely matters. And aside from the issues that are related to your family and what's best for you, this might be one of the most important things if you're planning or on consideration as to taking the lump sum payment. You want to know how this affects you in the big picture of things. And in a nutshell, most people don't do the planning to try to figure this out. Okay. And that's unfortunate because there are firms, certainly like ours, that are delighted to help you. That's what we do for a living. And we are encouraged on a daily basis because of all the feedback and the referrals that we've gotten from the thousands of people in the AT&T world that we've helped. I've been doing this for close to 25 years now, and I know a lot of AT&T people over the years. In fact, I've met with over 11,000 of them. That one of the things that was consistent with many of those folks is they had not done any planning prior to us talking. So if you're over the age of 50, which I am now, unfortunately, 74% of the population does not have a written financial plan. And there's just simply no excuse for this because this is something that we will do for you for free. So all you have to do is reach out to us, and you can either call us, you can email us, you can take a picture of this QR code to schedule some time. The info at theretirementgroup.com. That's the email address. Okay. Shoot us an email. We're delighted to answer a question that you might have or respond by trying to hook up with you on the most convenient time for you and your family. You can call us directly at 800-900-5867. You can take a picture of this QR code to the left, and that will give you access to a calendar where you can choose a time that's convenient for you to pick a time that one of our team members can help you. And you can also, again, schedule some time, or excuse me, take a picture of this QR code to the right, which is our LinkedIn page. And we've got a ton of great information that's on there for our AT&T folks. And so with that, what I want to do is basically pass the presentation back to Sam to make sure that we don't have any questions. And I've got a few minutes to answer some in the event that we do. Sam?
Hey, Patrick. Yes, we actually got quite a few really great questions. I want to make sure you answer them all.
Okay.
In the event that Patrick does not have time to answer them all, or we don't get to all of them, please click the link in the chat and you can book an appointment with Patrick after this presentation. Okay, Patrick, number one, can I defer my AT&T pension once I retire and wait until the rates drop in the future?
Absolutely. You absolutely can. And you may want to do that, especially if you have an inkling that the interest rates are going to go down. Because as we talked about, this has an inverse relationship, meaning that if the interest rates go down, they're going to give you more money. The caveat to that, or something you want to think about, is the opportunity cost of what you could do with your lump sum while you're waiting. And so what I mean by that is if you take the lump sum today and you put those monies into your IRA, which we hope that you get advised to do. Obviously, we would do that. We do that at Charles Schwab, by the way. We would set up your Charles Schwab IRA and land those pension lump sum funds in there, and then invest the funds that are, correlated to your investment goals and your retirement objectives and your financial well-being and your income needs and all these other things, and have the opportunity to start earning interest. Whereas if you postpone your disbursement, which you absolutely can do, you'd be waiting in hopes to get a better interest rate, which in turn would give you potentially more money, but you also have the risk of that going the opposite direction, right? So it's not just a one-way street. So unfortunately, if you choose to defer your pension disbursement and commence your benefit, you run the risk of the rates going up, which means you would get paid less money. And so really what you need is some understanding of where the rates are as we speak. And of course, the longer or later you get into the year, the more educated you can be on this, because that rate changes, as I mentioned, on a monthly basis. And so you'll have a better understanding of what that looks like closer to the November date. And then you'll have time to get off the payroll and commit your benefit if it looks like the rates are going to go up. But if it looks like the rates are going to stay stagnant or go down, then of course you have the right to defer your payment and see what happens the following year. Yeah.
Thank you. This next one is circling back to something you've already covered, but just to clarify for this person, what's a look back and how does it work?
Yeah, good question. So the look back is just simply related to giving you some data that would help you understand what the rates in the past have done. And just like investment results interest rates, past results are no indication of what the future is. But the reality is, it gives you some clarity on how they've transitioned, right? So they're sometimes really sharp changes. And so if you looked from 2018 to 2019, there was a sharp change. 2017 to 2018 was a fairly sharp change. One was beneficial, one was not. And so the answer really is it depends, but the idea it depends on when is best for you to take your a lump sum. But the look back relationship is just to give you some education. And what's interesting now is AT&T has recently, in the most recent few years, started um, sending out information to give you a warning that the rates are changing. They never used to do that. And so obviously, my guess is that it has something to do with in hopes of people exiting the payroll, which, as we all know, they're doing a pretty good job of that today. But in the end, the look back period is trying to give you some feedback on the most recent few years as to what the rates are doing, how that might impact you or affect you in your future going forward.
Great, thank you. Looks like we are getting close to our end time here. So let's just do this
Okay.
very last one. How should I use the direction of the rates and the look back to optimize my retirement planning?
Yeah, great question. Because we track this on a monthly basis, you need to call us. That's the answer. And we'll help you with the specific timing on what is best. And so, in a general sense, one of the questions that you'll have to ask yourself is how soon do you need money? Okay. So, if you're transitioning off the payroll and you're going to another job because the company asked you to leave or you got surplus and you still need to work, and the likelihood is you won't need the money, then we have to determine if that opportunity cost that I was just chatting about is either beneficial to you or a detriment to you. And so we can help you kind of gauge the aspects of what the timing is as to when to commence your technical benefit and whether it makes sense to roll the dice and risk running into the next year in case the rates do go down. So, in a nutshell, the more educated that you are about the disclosures and the information that AT&T is giving you on what's happening with your job and the flexibility of your company as a whole, in addition to what the rates are doing and how that applies to your pension plan, all are of consideration as to what to do and how to impact or what impacts your ultimate timing of when you decide to commit your benefit.
Alrighty, Patrick, we are out of time. Any closing statements before we end today?
No, I appreciate everyone's attention this afternoon. Hopefully, you got some value out of spending some time with us as we're here to do our very best to educate and service you to the greatest degree we can. So, with that, we do these things on a regular basis, and so hopefully, we'll connect with you next time. We'll check in, and we'll see you later.
Thank you, everybody. Have a great day.
Bye bye.